Imagine this. You wake up one day in your 50s or early 60s, and instead of worrying about bills, rent, or whether your paycheck will last until the end of the month, you realize you don't need to work anymore. Your investments are generating enough money to cover your lifestyle, and you finally have true financial freedom. Sounds like a dream, right? Well, what if I told you that you don't need to be a millionaire today, you don't need to win the lottery, and you don't need a crazy business idea to make this happen? All you need is a consistent plan, discipline, and the power of compound growth. Specifically, investing $1,000 every single month into the S&P 500. In this video, we're going to break down exactly how this strategy works, how much you could realistically build, what history tells us, the risks involved, and why this simple approach could be the key to your financial independence. So grab your notebook, because by the end of this video, you'll know exactly how this path to wealth works, and more importantly, how you can start building it today. Before we dive into the numbers, let's get clear on what the S&P 500 actually is. The S&P 500 stands for the Standard & Poor's 500, which is an index made up of the 500 largest publicly traded companies in the United States. Think of it as a giant basket holding shares of companies like Apple, Microsoft, Amazon, Google, Johnson & Johnson, Tesla, and hundreds of others. When you invest in the S&P 500, you're not betting on one company's success. You're spreading your money across hundreds of the strongest and most established businesses in the U.S. economy. Historically, the S&P 500 has delivered about 10 to 11% average annual returns before inflation and around 7 to 8% after inflation over the long run. This means if you stay invested for decades, the ups and downs even out, and the overall trend is growth. That's why financial experts often recommend it as one of the best and safest long-term investment vehicles for building wealth. Now you might ask, why $1,000 a month? Of course, you can start with less. Even $100 or $200 a month makes a difference. But $1,000 a month is a solid, ambitious number that shows the full power of compounding over time. Think of it this way. $1,000 is about the price of a fancy phone, a few dinners out, or a vacation trip each month. Instead of spending it, if you consistently invest it into the S&P 500, you're essentially planting seeds that grow into a financial forest over decades. Let's see what this actually looks like with real numbers. The power of compounding. Compounding is the eighth wonder of the world, as Albert Einstein famously said. It's when your money starts making money, and then that money makes even more money. Here's how it works with $1,000 a month in the S&P 500. After 10 years, assuming a 10% annual return, you'd have around $200,000. After 20 years, that number jumps to about $690,000. After 30 years, you'd be looking at around $2.3 million. And after 40 years, your portfolio could reach $6.4 million. All from consistently investing $1,000 a month and letting compounding do the heavy lifting. Now, you might think, there's no way it grows that big. But remember, the S&P 500 has been averaging about 10% annually for nearly a century. That doesn't mean it goes up every year. There will be crashes, recessions, and bear markets. But over the long term, the trend has always been upward. Let's take a step back and look at history. If you had invested just $100 a month into the S&P 500 starting in 1980, today you would have over $1.1 million. That's just $100. Now imagine $1,000 a month, 10 times that amount. The math speaks for itself. During this time, the market went through major crashes. The Black Monday crash of 1987, the dot-com bubble burst in the early 2000s, the 2008 financial crisis, the COVID-19 market crash in 2020. And yet, through all those downturns, the S&P 500 still rewarded long-term investors who stayed consistent. This is the key lesson. Time in the market beats timing the market. Now, let's talk about the biggest challenge most people face: sticking to the plan. It's easy to invest when the market is going up. Everyone feels like a genius when their portfolio is growing. But the real test comes during downturns. Imagine you've been investing for years, You've built up $200,000 and suddenly there's a crash. Your portfolio drops to $140,000. Most people panic, sell everything, and lock in their losses. But the truth is, market crashes are discount sales for investors. If you keep investing during downturns, you're buying stocks at cheaper prices, which sets you up for even bigger growth when the market recovers. So the mindset you need is patience, discipline, and faith in long-term growth. What does financial freedom look like? Okay, so let's say you stick to this plan. You invest $1,000 a month for 30 years and end up with around $2.3 million. What does that actually mean for your life? One popular rule for safe withdrawals in retirement is the 4% rule. It says that if you withdraw 4% of your portfolio each year, your money is very likely to last for decades, even with inflation. So, 4% of $2.3 million is about $92,000 per year. That's nearly $7,700 per month, completely passive. Now, imagine you push it to 40 years, reaching $6.4 million. The 4% rule would give you $256,000 per year, or over $21,000 per month. That's financial freedom. At that point, you're not working for money anymore. Your money is working for you. What about risks? Of course, no investment is risk-free. The biggest risk with the S&P 500 is short-term volatility. The market can drop 20%, 30%, or even 50% during recessions. But here's the important part. Historically, it has always recovered and hit new highs. Another risk is inflation, which eats away at your returns. But remember, the S&P 500 already accounts for this because companies adjust prices and grow earnings with inflation. That's why the long-term real return is around 7%. The biggest risk, honestly, is not the market, it's human behavior. Selling too early, panicking, or not sticking to the plan can destroy decades of progress. So, how do you actually begin? 1. Open an investment account. This could be a brokerage account or a retirement account like a 401k or IRA in the US. 2. Choose an S&P 500 index fund or ETF. Examples include Vanguard's VOO, SPDR's SPY, or iShares IVV. These funds track the S&P 500 with very low fees. 3. Set up automatic contributions. Make your $1,000 monthly investment automatic so you don't rely on willpower. 4. Stay consistent. No matter what the market does, keep investing. 5. Reinvest dividends. Let your dividends buy more shares and fuel compounding. It's really that simple. Let's make this even more real. If you started investing $1,000 a month in the year 2000, right before the dot-com crash, your portfolio would have been hit hard in the first few years. But if you stayed consistent until 2023, you'd still have around $750,000 to $800,000, even with the worst timing. If you had started in 2010 after the financial crisis, your $1,000 monthly investments would have grown to over $400,000 in just 13 years. The point is, consistency beats timing. The hardest part about building wealth is not the math, it's the patience. 30 or 40 years might sound like a long time. But think about it. 30 years ago, the year was 1995. That doesn't feel like ancient history, does it? The time will pass anyway. The question is, will you use it to build wealth or let it slip by? Investing $1,000 a month into the S&P 500 isn't just about money. It's about freedom of choice. The freedom to retire early, to spend more time with family, to travel, to pursue passion projects, or simply to stop worrying about money every single day. That's the real goal. So here's the takeaway. You don't need to invent the next big tech startup. You don't need to be a Wall Street genius, and you don't need $1 million today. All you need is a consistent habit, investing $1,000 a month into the S&P 500. Over time, that discipline turns into wealth, and that wealth turns into freedom. The question is, will you start today, or will you let another year pass by? Because remember, the best time to invest was 20 years ago. the second best time is right now. If you found this video helpful, make sure to subscribe for more practical strategies to build wealth and create the life you want. Until next time, keep learning, stay disciplined, and take one step closer to your financial freedom. And remember, this video is for educational and entertainment purposes only. It's not financial advice. Always do your own research before making investment decisions.